Imagine opening your mobile banking app before work this morning and seeing a healthy balance, manageable bills, and no financial emergency in sight. On paper, everything looks fine, yet every money decision somehow still ends with uncertainty and regret. You may have told yourself that the monthly payment is still affordable, or felt comfortable because the money is still sitting safely in the bank, while inflation quietly reduces its value. A bank account only tells you how much money you have, never whether the way you think about money actually makes sense. Many people do not go broke because they never had money, but because they relied on flawed financial logic for years while everything still looked stable. The danger is that flawed financial thinking often feels completely reasonable because it comes from advertising, social media, family habits, and the people around us. Welcome to The Margin, where we explore investing, money, work, and modern economic realities through calm, logical storytelling grounded in everyday life. Today, we will examine our own money thinking, identify 3 common financial reasoning mistakes, and explore a simple framework before the next financial decision arrives. Most of us grew up believing that as long as our bank balance looked healthy, our finances were probably doing fine. It feels like a practical shortcut, but it only measures the surface instead of what is happening underneath. 2 people can have the same bank balance today, yet end up in completely different financial positions 5 years later despite earning nearly the same income. The difference is not how much money they have, but the thinking behind the small decisions they repeat every single day. Think of money as a vehicle where your balance is the fuel, while your financial logic works as the navigation system. Even a vehicle with a full tank can still get lost if its navigation is wrong, just as savings alone cannot prevent poor long-term decisions. Ironically, the larger the balance becomes, the easier it is to feel confident even when that confidence may not reflect healthy financial thinking. This is where many people quietly assume that having more money automatically proves every earlier decision was correct. A good outcome today does not always come from good financial logic, because favorable circumstances can sometimes hide the real reason. Before talking about improving your finances, ask yourself whether your way of thinking about money is actually helping you grow. One of the most common money habits is judging affordability by the monthly payment, assuming the purchase is safe as long as the installment feels manageable. Being able to make the payments is not the same as truly being able to own the asset, even though the 2 ideas often sound identical. Once attention shifts to the monthly payment instead of the total price, the smaller number naturally feels easier for the brain to accept. That is why expensive products are often promoted by highlighting a low monthly payment instead of making the item itself any cheaper. Psychologically, breaking one large payment into smaller pieces makes a major financial decision feel surprisingly light. The problem is that life rarely includes only one payment, and every additional installment quietly reduces room for savings, investing, and unexpected expenses. Investors usually ask about the total cost, while consumers often ask only about the monthly payment, even though that single question changes the entire perspective. That is why many high earners still feel trapped from paycheck to paycheck because so much future income has already been committed to past decisions. Before saying you can afford the monthly payment, ask whether the purchase increases your wealth or simply extends your expenses over time. And installment thinking is only the beginning, because another quieter money habit can slowly reduce wealth without ever feeling noticeable. Another idea sounds perfectly reasonable. If money is still sitting in your savings account, your future must already be secure. Having an emergency fund matters, but treating every dollar in savings as financial security is a much bigger mistake than it appears. Imagine someone leaving nearly all of their savings in a regular bank account for years because investing feels too risky. The balance barely changes, yet inflation quietly reduces what that same money can actually buy over time. The hidden cost is not only losing purchasing power, but also losing years when long-term compounding never had the chance to begin. In finance, security does not mean money never moves. It means each dollar matches its purpose and time horizon. Emergency cash needs to stay liquid, but money meant for 10 or 20 years belongs to a different strategy. Many people think they are avoiding risk while they are simply choosing a slower risk that is harder to notice. Losing purchasing power rarely feels frightening because it happens quietly, one small step at a time over many years. The question is no longer whether the money is still there, but whether it is serving the purpose it was meant for. Small spending mistakes often begin with one harmless thought. It's only $10. No single coffee, subscription, or dinner creates financial problems, but repeating the same decision hundreds of times each year slowly adds up. One financial analysis estimated that unchecked small expenses can total thousands of dollars a year, and most people cannot even remember where the money went. This is not about avoiding enjoyment, but about choosing each expense intentionally instead of spending by habit. The phrase, "it's only a little," quietly stops the brain from asking whether the purchase is actually worth it. The more often this thinking repeats, the more financial decisions become automatic reactions to boredom, stress, or exhaustion. The greatest risk is not the amount itself, but teaching the brain that every emotional impulse deserves an immediate reward. Without noticing it, the mind gradually favors today's comfort over future financial freedom, especially when conditions become more difficult. Experienced investors still spend on enjoyment, but they usually know why every dollar leaves their account. If these three patterns sound familiar, they all come from the same way of thinking. To reduce impulsive financial decisions, use a simple thinking framework called the Logic Auditor that helps every choice begin with the right reasoning instead of emotion. The first question is whether this purchase becomes an asset or a burden, because assets add long-term value while burdens continue demanding future costs. The second question asks whether you are paying for the price itself or for the value that continues long after the transaction ends. The third question separates temporary satisfaction from long-term usefulness because today's excitement may not keep its value months later. This framework is not about avoiding purchases because it simply encourages more deliberate spending before money leaves your account. These three questions only delay a decision by a few minutes, yet that short pause often weakens emotion before a transaction happens. Over time, you may notice that many purchases once felt urgent but no longer seem as important a few hours later. At the same time, decisions that truly matter become easier to evaluate because the reasoning behind them becomes clearer. The difference between having money and managing wealth often begins with the quality of the questions people ask themselves. When the questions change, the quality of financial decisions begins to change alongside them over time. After seeing those three reasoning mistakes, you may quietly wonder whether your financial decisions have been based on a thinking system that no longer matches your current goals. Most people inherit their money beliefs from parents, friends, advertising, and social media long before they question where those ideas came from. The economy changes much faster than the financial logic many people continue carrying from decades ago. Improving your finances is often connected not only to earning more, but also to how each financial choice is interpreted. People who keep growing often spend more time questioning old assumptions than collecting perfect answers. During everyday purchases, a brief pause can reveal whether a decision comes from reasoning or simple habit. Looking more closely at daily spending can reveal how many transactions never carried much importance in the first place. As reasoning changes, money can gradually be viewed less as confusion and more as a tool connected to personal priorities. At that point, each dollar is connected to a specific purpose instead of drifting toward emotional spending. Over time, financial calm can begin to reflect how small decisions continue pointing toward the same future. We often assume wealth comes from a high income. Yet, over the long term, the way people think about money usually has a much greater influence than the size of their paycheck. Two people can receive the same bonus today, yet one sees a chance to buy something while the other sees a chance to buy time through investing. Nothing looks different on the first day, but years later those small decisions begin creating very different lives. That is why experienced investors talk more about opportunity cost than price, because every dollar spent also removes another possible use. Modern life encouraged us to ask whether we can afford something, while a different question asks what must be given up to buy it. Financial maturity reveals that every decision carries hidden costs, including time, flexibility, peace of mind, and future opportunities. This is why financial logic matters more than a bank balance, because logic sets the direction while a balance only shows the current position. When the direction is right, growth can continue even if progress feels slow, while the wrong direction can gradually drain even a large balance. A large bank balance alone is not the important part, because the greater question is whether the thinking behind it can keep it growing over time. In the end, money is only the result, while the logic behind every financial choice is what shapes the future over time. If you recognize one of these money habits in yourself today, don't treat it as failure, because many people inherit financial thinking instead of deliberately building it. The encouraging part is that financial reasoning can change, and major financial shifts often begin with small changes in perspective. Pay closer attention to everyday spending decisions, not to avoid spending, but to understand where each choice is taking you. Your bank balance only reflects past decisions, while future results depend on the quality of the decisions made after today. Better financial reasoning leaves less money tied to low-value choices and creates more room for assets, flexibility, and peace of mind. Perhaps financial well-being is less about owning the most money and more about how effectively each dollar is used over time. If this discussion helped you explore the psychology and logic behind money, you're welcome to join the margin for weekly stories about investing, personal finance, and today's economy. What money belief did you once accept as true but now see differently, and how did it affect your financial life?